the interesting thing is that is actually a very, very positive environment for gold and gold stocks. Not the recession itself, but the Fed's reaction to recession is very, very positive for gold and gold stocks. So I think we have an unusual and very attractive opportunity now to still buy gold stocks before they have had the leverage to the gold price and while they are still fundamentally inexpensive.
The precious metal has surged 22% this year, with an 8% increase since July. This rise has been driven by strong central bank purchases, heightened demand as a safe haven due to geopolitical tensions, and solid buying of physical bars in the over-the-counter market. Traders have fully priced in a Fed easing for this month, with a 65.5% chance of a 25 basis point cut and about 34.5% chance of a bigger 50 basis points reduction, according to the CME FedWatch tool. Last week, Fed Chair Jerome Powell indicated that the time has come to reduce interest rates, but the pace and extent of these cuts could be crucial in determining whether gold continues its upward trajectory. If the Fed follows through, we could see gold prices not only maintain their current levels but soar to new heights. UBS is calling for $2,700 in gold by mid-2025. Citigroup, Goldman Sachs, and Bank of America all see the metal hitting $3,000. However, as the Federal Reserve signals that interest rate cuts are likely, what are the risks? A 2024 recession is generally seen as unlikely, but metrics that economics take seriously hint that a recession could occur, perhaps in 2025. Adrian Day, upon examining the last 7 rate cycles, noticed that when the Fed begins to cut rates, it is typically very positive for gold. Interestingly, Day also points out that while a recession itself isn't inherently positive for gold, the Fed's response to a recession, cutting rates, tends to be highly favorable for both gold and gold stocks. However, in a more deflationary environment, monetary metals like gold and silver tend to fare better, while other commodities might struggle. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
Typically, if you look at the last 7 rate cycles, when the Fed starts to cut, then that is very, very positive for gold. Other commodities can act differently. If we're in a stagflationary period where we have inflation and a weaker economy, a soft economy, then typically commodities do well across the spectrum. And oil is often actually the leader, outperforming even gold. If you're in a more deflationary environment, then that tends to be much more positive for monetary metals, gold and silver, but much less positive for commodities. So I think an awful lot depends on just how bad the economy gets. Soft growth or zero growth plus inflation for commodities will do very well. If the Fed starts cutting rates, that's going to have an impact on the economy, but also on all markets. Typically we would expect that when the Fed starts cutting rates, then there will be a period, whatever that period is, a year, 2 years, of rate declines, whether it's every meeting or every second meeting or whatever. But the trend will be to cut. They don't cut, then raise, and cut, then raise. You've got to start really cutting rates meaningfully for it to have an impact on companies and households whose interest rate charges have gone up so much. So typically, when the Fed starts cutting rates like that, it's a sign that we are in or heading towards a recession. And the interesting thing is that is actually a very, very positive environment for gold and gold stocks. Not the recession itself, but the Fed's reaction to recession is very, very positive for gold and gold stocks. Interestingly, if you look at history, it's a lot less positive for stock markets. And it makes sense because when the Fed starts cutting rates, it's a sign that the economy is slowing. If the economy is slowing, then even if companies are helped on the interest rate, on the debt side of the equation, they're finding demand for their goods and services goes down. And so we're going to start to see earnings, decline, and that typically is bad for stocks. So I think the period we're heading into will be positive for gold and gold stocks, negative or neutral at best for the equity market.
For seasoned gold mining investors, this should be a moment of validation. The yellow metal has long been seen as the ultimate hedge against economic uncertainty. And yet, despite the bull run, gold stocks, those companies that mine, process, and sell the metal, are trading at historically low valuations relative to the market. The real, inflation-adjusted 10-year Treasury yield rose from a low of around -1.2% in August 2021 to nearly 2.5% in October 2023. And for many investors, particularly those in Western countries, rising yields are a signal to sell non-interest-bearing gold. From the end of 2020 to May 2024, exchange-traded funds, ETFs, backed by physical gold shed approximately 30 million ounces, over a quarter of their total holdings, as yield-seeking investors pared back their positions. When asked if the situation will change soon and if it presents a good opportunity in mining stocks, Adrian Day responded with an emphatic yes on both counts. Day believes that now is an unusual and highly attractive time to buy gold stocks before they gain leverage to the gold price while they are still fundamentally inexpensive. Let's now turn our attention to the video again.
Do you think that will change soon? And if so, is it a really good opportunity in the mining stocks right now?
Yes and yes. It already is changing very slowly. I mean, if you look on a 12-month basis, gold has outperformed. If you look on a 6-month basis, more or less the same. I'm just looking right now, and it shows gold up 22.3 and the XAU up 23.5. So basically the same. That's year to date. If you look at 6 months, then the stocks have well outperformed. If you look at 1 month, the stocks have outperformed. So I think and so is silver, by the way. So I think we're beginning to see that turn where the gold stocks and silver outperform physical gold, which is what we normally expect in a gold market. This gold market has been different, of course, because of the source of the demand and why people have been buying gold. So when central banks, as we know, have led the gold market over the last 12 months, 18 months, and central banks are buying physical gold. They're not buying Newmont or Barrick or, let alone junior exploration stocks. And so it makes sense when you think about who's been buying and why they've been buying, it makes sense that gold has gone up more than the stocks. But that is beginning to change. And I think this is a remarkable opportunity, to be honest with you, Elijah, because normally at the beginning of a gold bull market, and go back to 71, 76, 80, 2008. At the beginning of a gold move, the stocks tend to outperform at the beginning dramatically. Once gold bottoms and starts to move, the gold stocks outperform dramatically. So go back to 2000, for example. I think gold was up about 12% in the first 3 months, which isn't bad for an insurance asset. And the gold stocks were up over 50%. So that's the typical sort of, and we saw that in 2008 as well. So I think we have an unusual and very attractive opportunity now to still buy gold stocks before they have had the leverage to the gold price and while they are still fundamentally inexpensive. And that is something, a lot of people, as Oscar Wilde once said, people know everything about price, but nothing about value. And you look at what the gold stocks have done in the last, 2 months, and you say, oh, I'm not going to chase these stocks. We forget that, first of all, the stocks, just in terms of price, are a lot lower than they were in 2022, let alone 2011 and 2012. But in terms of value, I've given this example before, but you look at Agnico Eagle, for example, which has had a very strong move this year on the back of some very strong quarterly reports. Agnico Eagle is selling at about 8 times cash flow. And if you look back at its history, it has rarely meaningfully lower than that. So it is selling very, very close to its all-time low in terms of price to cash flow. Barrick, for example, on a price to net asset, same thing. It's within a couple of percent of its all-time low price to net asset. And when you've got gold making new highs, you expect multiple expansion. You expect the stocks to trade at higher multiples. So no, I think we have a very, very attractive.
Historically, gold has seen its most significant gains when the Federal Reserve cuts interest rates during times of economic uncertainty. While there is no immediate crisis on the horizon, markets are currently anticipating a 25 basis point cut at each of the upcoming Fed meetings in September and November, with an even larger cut expected in December. As economic conditions deteriorate and unemployment rises, investors often turn to gold as a safe haven asset to guard against economic uncertainty and potential declines in the equity markets. Furthermore, if the Federal Reserve lowers interest rates to stimulate the economy, the US dollar could weaken, making gold more appealing and driving its price higher. Consequently, these indicators, which suggest a potential recession and lower interest rates, could lead to increased demand for gold and a bullish outlook for the precious metal. Drop your comments below and let us know what you think. If you found this video helpful, please like it and subscribe for more. We're grateful to have you with us on this journey.